Hi everyone, today's Tuesday, February 2nd, and it's around 8:30 a.m. Last week I mentioned that I thought it was problematic that the Fed wanted to raise rates while the rest of the world wanted to drop rates. I suggested that the Fed might have to reconsider the speed at which it would raise rates. Wednesday we got our answer, as the Fed chose not to raise rates. Then on Friday, the last trading day of the month, which at times is accompanied by increased volatility and institutional position squaring, the Central Bank of Japan chose to drop rates, thereby pushing their short-term interest rates negative. This caused a virtual buying frenzy for stocks and bonds in the Dow, closing up almost 400 points on Friday. Market action Friday is further evidence of the interconnection of worldwide markets. So many of you might be wondering, how can you have negative interest rates? What this means is that if you buy short-term Japanese government bonds, you will have to pay the Bank of Japan for the right to park money in their bonds. Seems crazy, right? But what the Bank of Japan is trying to do is to force financial institutions in Japan that buy a large quantity of their bonds to instead lend that money out in order to stimulate the economy. This in turn should help bring Japan out of its current economic slowdown and reverse a potential deflationary spiral there. In addition, it acts to weaken the Japanese yen, thereby making Japanese goods and services more attractive on the worldwide market. The European Central Bank in June of 2014 was the first major central bank to venture into negative territory, followed by the Swiss National Bank in December of 2014. The Danish Central Bank has also employed negative rates to defend their currency against the euro, while Sweden's rates are also in negative territory. Former Federal Reserve Chief Ben Bernanke has said that in the event of a serious downturn, negative interest rates are a tool that the U.S. Central Bank could consider. When Bernanke said this, he knew how in 1936 the Fed reversed a discount rate hike and then eased when the U.S. was deleveraging a long-term debt cycle. They hiked the discount rate by 0.5% in 1936, then eased until 1940. It's my opinion that our current Fed could repeat this action again should conditions worsen, hiking once again, then easing by way of negative interest rates or even QE4. So what does all this mean? As Europe and Japan explore negative interest rates, it pushes the dollar even higher against their respective currencies, making our goods and services abroad more costly. And should our Fed raise rates, this will put added upward pressure on our currency. As a result, I believe the more likely scenario is a much more significant delay in the Fed's policy of raising rates or even reversing course and going to negative interest rates. As I've said before, such a rising interest rate policy could derail our fledgling recovery, and I don't think the Fed wants that. So with all that said, a slower Fed hike policy or even a reversal towards negative interest rates should be a positive for our markets. Therefore, I remain optimistic about the near-term prospects for our markets. I hope everyone has a great day, and remember, if you should ever have any questions regarding anything financial, please don't hesitate to call. And thanks for listening.